Welcome to another episode of the Davidoff Wealth Podcast. Today I have my co-host Michael Davidoff on, and today we're going to be discussing diversification and what that means in the context of financial planning and overall financial picture. So let's start by defining what is diversification.
Well, very simply, diversification is a way to own different asset classes as a way to reduce risk. Just by way of example, think about if I were a landlord and uh, I owned 5 apartments in or 10 apartments in a particular area of New York, and that area is not doing so well, and I have 2 or 3 different units that are vacant there. Chances are that if I diversified and I owned units in a different market, whether it's New Jersey, California, Florida, or Texas, they're not necessarily correlated. So you're looking for things that are not correlated as a way to reduce risk so that you can have better outcomes, more predictable outcomes as an investor.
Okay, so can we also talk a little bit about asset class diversification?
Absolutely. So part of diversification is you want to invest in different asset classes. What does that mean? So you can have asset types. For example, stocks are a particular asset type. You can have bonds, you can have real estate, you can have alternative investments. Even within each of these categories, you might have different asset categories or subcategories. For example, in stocks, you might have US stocks, you might have international stocks. It's important to diversify geographically. It's important to diversify in terms of the types of companies, the type of industries, the types of sectors, and also the asset classes. You might have growth companies, you might have value companies. So it's important to incorporate all of those within a portfolio as a way to reduce the risk of that portfolio.
Additionally, you also want to avoid being solely in tech or solely in manufacturing.
Goodness, I have some stories to share with you. When I was in my 20s and started making some money, that was now we call it dot-com bubble. At the time, it didn't seem that way. It was a new wave of new technologies, which of course we're continuing to have today with AI and other things. But so many people put all of their eggs into that one basket. And all of a sudden you had millionaires, and then the next day you had people that were bankrupt because they put all their eggs in that one basket, right? The saying goes, don't put all your eggs in one basket, to make sure that you're diversified. And it's such a hard thing for people to do because we all have biases and think that we know what's going to be in the future. And the reality is there's many people before you that came that thought the same thing. And if we learn from history at all, we learned that diversification is crucial to the success of a portfolio and the success of you as an investor and your future.
So let's take a step back and discuss what are the major benefits of diversification.
Yeah, you can't predict which assets are going to be up. So it's a hedge against having one asset class that might be down. For example, interest rates go up, real estate's probably going to hurt as an investment. And so if all of your eggs are in real estate, then that's not good because you may be hurting in that asset category. And so if you have stocks and bonds and other things, it will make up for that loss perhaps on that investment. And next year when real estate rebounds, it will do better, and other things might do not as well. And so having the diversification of lots of different types of assets is important to mitigate the risk that you have.
So you talked about when one asset goes down, you have the opportunity to keep your portfolio not as stable, not as dependent. Let's discuss a little bit about rebalancing while we're on the topic and how that can help when you're diversifying.
Sure. So rebalancing is a form of taking from the one category that maybe has gone up in value and realigning that portfolio to essentially sell off some of those things that have gone up and buying those things that are at a discount or below where the market should be. So just as an example, a simple allocation of, let's say, 50% in stocks and 50% in fixed income in bonds, you might have, for example, in the 2008, 2009 stock market crash, a lot of the pension funds that have employed this type of a strategy, they were able to rebalance and buy large holdings of stocks because stocks were down at that time, and they did it systematically because that was part of their diversification strategy and the rebalancing. And so we employ that same philosophy and that same way of doing things. We diversify into multiple asset categories, and then on a periodic basis, we will rebalance the portfolio, making sure that we're systematically buying at a low price and selling those things that are at a high price. And that's what rebalancing does for a portfolio.
This also allows clients to stay within their desired risk tolerance. For example,
Absolutely.
if they come in initially wanting a 30% allocation to fixed income and a 70% stock allocation, let's say after a few months, stocks do very, very well and they're at 78%, 22%. That may not be in line with their risk profile that they wanted. So by being able to rebalance the portfolios correctly, we're able to bring them back to that ideal risk tolerance that they came in with.
Yes, absolutely. Um, we have something called it's sort of the runaway risk that happens. For example, if you have stocks in a portfolio and those stocks are going to traditionally they're going to grow at a faster pace than the fixed income portion of the portfolio. And so if you don't rebalance, what happens is the risk becomes higher and higher over time because you end up having more stocks in your portfolio or a heavier tilt towards that. And what we want to do is reduce that or to bring that risk back into the right balance of what you had. And so making sure that that rebalancing happens is crucial in any portfolio.
So while we're on the topic of runaway risk, let's discuss a little bit about some of the practical applications of diversification, and especially how we've seen in tech and certain other sectors, people not rebalancing and how that affects their portfolio.
Yeah, and it's sort of a repeating theme that I see in history. I've seen people uh, that end up having 80 or 90% in one company. And to me, it's crazy. We try to ensure that none of our clients have more than 10% of any of their holdings in one company or in one sector. That could really be detrimental to them. And I'm speaking from experience. I can tell you that when I started as an investor probably about 30 years ago and started making some money, one of my clients was this big tech company. It was an internet service provider. And I was in the business of helping them find people for their offices, and they were growing leaps and bounds. And I thought, this is great. I've made at the time it was a couple $100,000 a year that they were paying me to help them with their recruiting efforts, and I was reinvesting that money into their stock, and that stock went up and up and up, and only to learn that even as somebody who was not an insider but close to that I didn't know all the information. That there were some announcements that were made in that company that really made it detrimental as an investor. That company filed for Chapter 11 bankruptcy. Here goes the majority of my money. And so it was an expensive lesson to learn that you need to diversify no matter what. And it's important not to have all of your eggs in that one company, even if you're working for that company. And this happens often. You'll have companies that offer stock options. They'll offer the ability to purchase stocks at a reduced price. But investors need to think about, how do I diversify away from that over time, instead of being so entrenched in that one holding.
So what are some other examples of clients or stories that you've heard where diversification could have made all the difference?
That's a great question. I'll give you a few examples. One that comes to mind is a client who got spooked in 2008. And by 2009, he had taken his, at the time, I think it was about $500,000 that he had saved up in his retirement account, and he moved it from what was perhaps too aggressive in the market, and all of a sudden it went down because it was a lot more right before he moved it. And he decided that he couldn't take that risk tolerance. And so he moved it all into bonds, essentially into a money market type of an account, which gave him very low risk, but very low growth. And he thought, well, I'm going to get back into the market when the timing is right. And it wasn't until 2016 when I met with him and I said, well, you've been out of the market for this long. When are you going back? And he said, well, I've been trying to go back all the time, but it's all too expensive. Well, if we look at 2016 to where it is today, we know that the market is a lot higher today. And so luckily for him, he went back into the market and he ended up continuing to work because he made a big mistake by going out of the market. And so the lesson here is you've got to stay the course and you have to be well diversified. He was too heavy into stocks because the market was going up and up and up. Up until 2008, 2009, when the market had a correction, and a big one to that. And he suffered more than other people because he took on more risk than he should have. And so the lesson here is make sure that you're well diversified, make sure that you could ride things out. And that diversification is going to help mitigate some of these ups and downs. And then when the market does have some ups and downs, you'll be able to take advantage of it by rebalancing your portfolio and essentially buy at that discount and sell those things.
So it seems that he actually lost due to diversification on two fronts.
He did.
In the beginning, he wasn't diversified enough and he was too focused on stocks.
Right.
And then later, he lost so much money. He didn't diversify and he had his money in money markets, and he lost because he didn't take the risk necessary.
Correct. And so there's a bias that we all have as humans where we think we know, and we have this bias, and people always are overconfident when they shouldn't be, when the markets are good. And so they end up putting much more money into equities or to things that are riskier versus making sure that they're well diversified for the long term. And then when things are in pain, they often don't take the appropriate level of risk. For example, just recently I had a client who said, I'm trying an assisted living facility. We just sold this house and I'm afraid to go into the market. And I said, well, we need to have a well-diversified portfolio that's going to ride out things. And yes, the market was down. She could have gone into the market by dollar cost averaging into it, which basically allows you to put a little bit at a time into the market. She didn't do that. Now the market's higher today, and there was a lost opportunity. And so she's still outside of the market, not knowing, and inflation's eating away at that money. So making sure that you're well diversified is important, and that we have a long-term game plan.
Something we frequently say is time in the market beats timing the market.
Absolutely. And it's hard. You'd have to know when to time the market to get in, when to get out. Most people can't do that successfully. And if you're doing that successfully once or twice, chances are you're not doing that successfully for the course of your life. And at least that's been the experience of what we've seen from research and from science, and from personal experiences of seeing investors out there. Another form of diversification I want to talk about is really diversifying into different things, and how important that is. Whether you're a business owner and you've got a product that's selling wonderfully, great. Think about the next product that you need to diversify into, so that you have 2 different lines or 3 different sources of income, or 4 or 5. I think last time I counted the things that we did, probably there's probably like 15 or 16 different sources of income that we have, whether it's real estate, stocks, bonds, different businesses that we own. Really important to make sure that you have a well-diversified strategy, not overly diversified. I think you can go back and make an argument that you don't want to be in too many different things, because it takes time to learn and get yourself up to speed about different
There's a
things.
learning curve for everything you want to
Absolutely.
learn. It takes time. So you don't want to overly diversify necessarily in asset classes. But it's very important.
Absolutely. Just as a simple example, let's say if we're going back to the real estate, if you were to own 10 different apartments, it might make more sense to do it in 2 or 3 different markets than to do, buy 10 different condos in 10 different markets with 10 different laws and 10 different regulations.
10 different places you have to fly out to visit.
Exactly. So always better to focus in, but also make sure that there's lack of correlation. Correlation is you don't want things to move in the same direction, which is why sometimes if you're investing in the US, you want to invest also in internationally. So you want to have things that maybe the US market is suffering, but the international market is not feeling the same pressures that the US market is feeling, and vice versa, right?
Let's just take a few minutes to discuss real estate and some of your journey in real estate.
Yeah. I've been involved in real estate for about 20 years or so. I grew up with a dad who was in the real estate business, so I've had a lot of experience watching other people do it as well. Started out as doing flipping, and then became a landlord in and around New York City and in Florida, and slowly that migrated into doing development projects, then owning larger multifamily apartments in Texas and in Florida and in New York as a way to diversify the income source. I've seen that as being really effective, making sure that you have different types of income sources, because you can't be you want to create some passive income. This is a great way to do that, particularly for investors that don't want to become landlords. We're giving them an opportunity to learn how to do that and kind of be investors alongside with us.
So you, in short, allow people to invest as limited partners while you handle more of the management decisions on the property.
Team and I are heavily invested in making sure that these properties are performing the way that they should, that we have a business plan for getting the maximum value out of them. And we're investing a significant amount of our own money into it and allowing other limited partners to join us as investors so that they can make a passive income for themselves. It's always nice to get checks in the mail, so to speak.
This seems like a great opportunity for investors who maybe want to get into real estate but don't have the maybe knowledge or time to understand that learning curve.
Yeah, I think a lot of people have heard real estate is a good place for people to be in, but oftentimes it requires a significant outlay of money, or maybe people are busy as professionals or doing other things, and the thought of being a landlord and having to replace a toilet or having to get a phone call in the middle of the night is not what they want to deal with. And so they sort of rule out real estate, but they really shouldn't. Real estate can be so much more than that. You can be an investor as a limited partner. What you're looking for are all of the benefits, the tax benefits that you get from owning real estate, the ability to leverage that real estate loan, the ability to have the passive income. You just don't want all the headaches, which is something that you want to pawn off on somebody else. And so we take care of all of that for our clients because we're doing them on a large scale, and we're allowing our clients to also participate as limited partners on these deals. So it's a good strategy for a lot of people, particularly professionals that are busy, worried about, I won't be able to generate money down the road if I stop working. So how do I replace that income? And so this is a great way for them to do it as part of the strategy. It shouldn't be all of the money that's put in there. It should be part of a well-diversified portfolio. And real estate is definitely a part of that and should be for every investor.
So if we can end this episode with one piece of advice to the younger generation, the older generation, to everybody, what would it be?
Well, I would start investing early. I would diversify and make sure that you do that systematically and look at it as a long-term perspective. Don't look necessarily on what's hot today, because we have these biases that really steer us in the wrong direction. So you want to be a long-term investor, diversification, lots of different asset categories We can help you optimize it, work with a professional that's going to help you do that, and really have a long-term outlook on things. And don't pay attention to the news so much. Oftentimes, I feel like they're there to make sure that you're watching them. They're not there to make sure that your investments are going to be there for the long term. So make sure that you work with somebody who has a vested interest in your success.
News outlets typically get paid on viewership. The more intense their headlines are, the market is crashing or whatever else they're saying, the more likely you are to watch. So always be aware of why people are giving the information that they are. What's the benefit that they have for communicating it to you? And time in the market beats timing the market.
Absolutely. Good advice. And with that, let's wrap it up.
Thank you, guys.